what that means is that there's like a pent up energy consumption that will come, right? So your middle class or your increasing middle class in Southeast Asia, et cetera, they also, when it's, 80 Fahrenheit, they kind of want to have an aircon running as an energy intensive. So, but, the point is that you don't even need to have that demand. We can have and are already having an inflationary impact purely as a consequence of supply, right? Because it's a depletive industry. All of the fossil fuels is depletive industry. It's not like this. It's you're clearing out the pantry. At some point, you've got to go back to the supermarket. So the pantry clearing has been taking place at the same time that there's no replenishing of supplies.
Yep.
Now we have geopolitical conflict.
Chris McIntosh, how you doing?
I'm well, thank you. How about yourself?
I'm doing really well. Becoming a fan of yours. Two things that really stood out to me in listening to you is, one, your sense of calmness. I think that's very admirable. And we lived in some really crazy times. And then really your long view and your simplistic view, and I mean simplistic as a big positive view of things, as opposed to getting stuck really in the weeds. And that's really what I want to get to and talk with you about your view on energy and why your energy interests you. And yeah, talk to me about that.
Sure. I guess it still starts with having a fundamental platform as to how you're going to go about investing. Most people transition or they bounce between trading and investing, and they don't quite know necessarily where they are. They'll hear some soundbite here, and then they think they need to do something, and they'll take an action. And what you land up with is some level of certainly higher anxiety. You don't have a strategy. If you're a trader, you're a trader. If you're an investor, you're an investor, and they're completely different animals. And I see a lot of people trying to do both. And so it's to the point of calmness, which you mentioned, and also our strategy, how we go about doing things. Fundamentally, it comes back to these: you need to decide what is the outcome that you're looking for, and how are you best suited to get that outcome, and then work backwards and figure out a methodology to getting there. I'll give you a quick example. In every particular bull market, especially in commodity markets, you have volatility. You have especially volatility near the bottom of the cycle, and that's purely as a consequence of lack of liquidity. And then you'll have volatility during that cycle, but and near the tail end, your volatility tends to lower. The lowering of volatility is something that people mischaracterize as risk. So where they see something as being volatile, they automatically think of it as risky. It's not necessarily true. So if you take a stock that's, I don't know, been decimated, down 90%. Let's say it was $1 billion company and now it's, I don't know, $100 million market cap. There are less participants in that particular stock than there were at the peak, obviously. With less participants, you can move the stock more. You can have one holder who happens to hold 10% of the stock and they dump it for whatever reason, or they buy it for whatever reason, and it'll have a material impact on the stock greater than it would be if that was a $1 billion stock and they had the same capital allocation. So that doesn't have any relation whatsoever to do with the fundamentals of the company. It's purely a consequence of liquidity and the free float. When you get to the bottom of cycles, you therefore have greater levels of volatility. In order to manage that volatility, you need to figure out a plan. You need to figure out how are you going to deal with drawdowns, with market volatility, whereby you might have a position that you put on a month later, it's down 20%. How are you going to deal with it? For some people, they say it's too much. I'm going to have stops in there, and I'm going to just get out if it drops by 15% or whatever it is. That is a misunderstanding of, again, volatility. That company can have absolutely nothing wrong with it and can move 15, 20% on almost no news. That volatility, as I've mentioned many times before, is not risk. So what that comes down to is having a strategy. The strategy, as you probably are familiar with now, being a reader, is that we tend to position size accordingly. So if you're taking a position size in that particular equity, the mythical company, and it's a 1% or 2% position size, and it moves 20%, overall in your portfolio, it's going to have bugger all impact. It's not going to affect you. Your mental balance with that is unaffected, or should be unaffected, unless you're sitting there looking at it, and then it's purely just a narrative in your head saying, "Oh my gosh, I'm down 20%. What's wrong? Did I mess it up?" Etc., etc. Which is fine, but overall, it's not going to have any impact on your portfolio. It gives you the ability to calmly and rationally go and look at what it is you bought and say, "Okay, the reasons I bought it, are they still in play? Are they not in play? What's going on?" So that's one of the things we try and teach people in the Insider program. It is how we manage our capital at Glenorchy Capital for clients and our own money. What all this ties into is major trends. If you take small positions in sectors that are beaten down, left for dead, and fundamentally are in your favor, in other words, asymmetric, the risk is relatively low comparative to the upside, comparative to the reward potential. If you go and you position size that accordingly, and you are cognizant of the fact that this is a multi-year trend, and this happens regularly, it doesn't matter if you're in biotech or in commodity stocks or cyclical consumer goods, it doesn't matter. Every single sector has their own cycle, and every market has its own cycle, and you have business cycles and credit cycles and all these sorts of things. If you pay a lot of attention to those, you'll understand that the vast amount of capital appreciation or capital loss in any stock is typically down to the sector that it's in. The old adage, a rising tide lifts all boats, is somewhat true. So if you think of the tech sector, right? When we had capital pouring into that, you could have a fairly garbage company that wasn't profitable. And in most instances, you still did okay. So about 80% of the move in any stock price is down to the actual sector. So it's more worthwhile paying attention to the sector and to the trends as opposed to the individual company, which is not to say not to pay attention to it, but simply in terms of allocation of your time and expertise, that's where it logically would rest. If you knew that roughly 80% of any outcome is down to that trend, down to that sector, surely you should pay more attention to that than something else. So that's broadly what we do. And that has led us into mostly commodity stocks. It's led us directly into the energy space. So we let the market tell us where we need to be, as opposed to trying to build some narrative and justify your own decision making. Because again, this is a psychological game. Investing, for the most part, anyone can read anyone that's had some level of education can go and read balance sheets and income statements. There's no unique edge that you've got in that. I can go and I can hire any analyst out there, and in many instances where they've been institutionalized, they're actually they have to be retrained.
Yeah. And they'll sell you. That's the thing, is everybody's selling you something, right? Yeah.
It comes down to what works in terms of okay, so there's different industries. You've got your fund management industry. You have the newsletter publication, investment newsletter industry. And we break those down. In the fund management industry, by and large, what we've seen over the last 20, 40 years has been an accumulation of capital into quote unquote passive capital, indexes, right, mutual funds. It's largely algo driven. And the fee, so you go, okay, how do people make money? Well, they make money by basically charging no carried interest and a small-ish fee on the front end. And they churn out as much as they can and they push as much capital into it, while in terms of managing that capital, they basically don't manage it. They'll have an algo running it.
Mm-hmm.
In terms of the business model, they spend all or a vast majority of their capital up front trying to get people into the funnel.
Right.
So it's a very heavy marketing oriented business, and it is purely accumulation of capital. They'll charge you maybe 85 bips on a few $1 billion and they make a ton of money because their capex or their opex actually is relatively low. They're not really hiring a whole lot of analysts. They're not hiring anyone. They're just running it through a model.
Yeah.
And it's an aggregation. It's some variation of a 60-40 bond split, the risk parity trade, and then they'll chuck you into these various products. Anyway, so that's the business model. I'm not saying it's bad. It doesn't really matter. It is what it is. But understanding that's what it is also affords you the ability to say, okay, if the vast majority of the capital in the world is going in towards that, what are they not looking at? Where is my edge? And so for active fund managers like ourselves, we look at one of the key components behind this is an inability to take a longer term standpoint view.
Yeah.
Because aggregating capital requires a couple of things. It requires heavy marketing to pull people in, and then it requires not losing them. So the not losing part is basically like having a lawyer or an accountant run your portfolio. Why? Because they're super risk averse. Okay. They just don't want to lose money.
I might add, they hate drawdown.
Say that again?
I said they hate drawdowns.
They hate drawdowns because they'll get redemptions. And so a drawdown is okay if the rest of the market's drawn down. So like if you're in your particular fund and it's down 20% and the S&P is down 22%, they just go, oh, well, see, we beat the market. We're okay. And by and large, that actually works. So they have a very, very different profile as to how they're going to manage the capital. What it means, and this is because so much capital has moved into that quote unquote passive space, is that there is a huge market opportunity for people like myself, where we go in and we say, we don't care about what happens in the next quarter, half year, even 12 months. They're worried about that. We're not going to worry about it. We're going to go further out in terms of time frame analysis. And what that leads us into is particular equities and companies and sectors that they simply can't touch. If a sector is not already on the move for them and it's favorable and it's hitting 52-week highs or whatever the particular metric is that they're running their algos on, they're not going to touch it. Doesn't matter how absolutely cheap and amazing it might be. They don't care. It's all about pulling it in from a marketing standpoint and holding it, keeping it. And that just means they don't want redemptions. What it means also is that there's very, very few players in the stuff that we look for. Okay. So aside from the fact that their business model is all about aggregating capital, like they'll have billions of dollars charging 85 bips or 50 bips or whatever with no carry. So their business model requires them to have huge amounts of capital. Our business model doesn't require us to have huge amounts of capital. We charge more, much more. Well, I'd like to think it's worth it. And we certainly have managed to prove that thus far, touch wood. But the point I'm making is that we go into stocks and sectors that they can't touch, and we can hold them for a longer time. So that when they do inflect, we have, I don't know how long you've been with us, but we can have some very, very good outcomes, which we've had. So that's just in terms of structural portfolio and how one can think about where to look. And so we're agnostic as to markets. We'll go anywhere where there is value and where it makes sense to us. And where the market has led us predominantly, again, is into the commodity space and into the energy sector in particular. And that's across the energy space.
Well, let's talk about that. So let's talk about what you just said and why, and I know why, but it's somewhat rhetorical, but I want you to talk about it. What's led you to the energy sector then?
The highs in that space were back in sort of 2012, 2014. Again, these are very cyclical markets. Your commodity markets run 7 to 15, depending on the cycle, years, boom and bust. They're very capital intensive, which is also what leads it into a boom and bust. In order to go and get a new, drill rig out in the ocean, for example, it's capital intensive. It's going to cost you about $1.2 billion. You're going to need 4 OSVs, offshore service vessels, to service it. They're going to cost you probably about 80 each. This is not equity financed. This is debt financed. So now they have to go into the debt markets. If the participants that were in that in the last cycle are looking at it, they're very shy. They just lost their shirts. Okay. So there's a real reticence to coming into the market until you have real validation that, oh my gosh, yes, this is true. I can make some money. That's in a normal cycle. Right. We're not in a normal cycle as a consequence of all this sort of woke DEI and ESG garbage that's being thrown around. And what that's led to is an exacerbation of a lack of capital expenditure. If you and I were to run around Wall Street now and shop a new energy fund that was investing in coal or oil, we'll get chased out of the room. Okay. Right. That's fantastic, because what it does is it builds a moat around your existing players. There's a moat. There's no entrance, right? There's no one going to raise the capital to come in and compete with those existing players. At the same time, that demand is now picking up. So this is largely a supply constrained, stagflationary environment that we've been talking about for years, that we've said is coming, and it's now here and we're in it. That environment is one whereby you can have a shitty, stagnant economy at the same time that the cost of critical goods are going up.
Yeah.
That's without geopolitical conflict. Geopolitical conflict always, every single time, brings inflationary outcomes, because governments have to borrow money. They have to borrow money to fight. Wars are very expensive.
Yeah, of course. Yeah.
And energy always gets fought over. You can't fight a war if you've got no energy. So there's a lot of different factors behind the fundamentals in the energy space.
Yeah.
At the same time that we still have a continued growth.
Yeah, that's interesting. Yeah, it's interesting. Okay, so these how do we say it? I guess this is what energy has going for it, if you would. And meaning is capital intensive, and there's been a lack of capital coming in because it's coming off some lows. Demand is really high. Correct me where my thesis is wrong, and this is what you're saying. Demand is really high, and or I guess it's becoming higher. And this
demand,
is that,
just very quickly, sorry to interject, but I assume that much of your audience are US or Western based.
Yeah, I would say 60%.
Okay. There is a commonality in that US people in particular tend to be focused more broadly on the US markets to the exclusion of others.
Absolutely.
Which has been fine for decades because it's been the largest economy in the world and so on and so forth. Missing the point that there are other economies that are now substantially larger, that account for substantially more GDP in the world.
China.
Exactly. So if you look at the BRICS, for example, the BRICS is easily larger than the Western world now. That's just the way it is in terms of numbers, in terms of many, many numbers, obviously in population, but also in terms of things like percentage growth.
Right.
So in total energy consumption, it's not. But what that means is that there's like a pent-up energy consumption that will come, right? So your middle class or your increasing middle class in Southeast Asia, et cetera, they also, when it's, 80 Fahrenheit, they kind of want to have an aircon running as an energy intensive. So But the point is that you don't even need to have that demand. We can have and are already having an inflationary impact purely as a consequence of supply, right? Because it's a depletive industry. All of the fossil fuels is depletive industry. It's not like this. It's you're clearing out the pantry. At some point, you got to go back to the supermarket.
Mm.
So the pantry clearing has been taking place at the same time that there's no replenishing of supplies.
Yep.
Now we have geopolitical conflict. In a geopolitical conflict, what do? You hoard the things that you need.
Yep.
The biggest component of all of those easily is energy.
Yep.
So what we're watching, for example, with respect to Chinese banks across Africa in particular, and I know I put this out in the last issue of the Insider, is an accumulation of those resources all across Africa. They are controlling that supply. And they're doing it for many reasons, not just to boost their own and prepare for their own economy, but also it's a geopolitical play. If you control the energy, you can control pretty much anything. So these are all things that are transpiring on the back of a fundamental supply constrained industry at the end of a bear market. So the bear market pretty much ended around 2016, and we've not had much capital expenditure at all as a consequence subsequently. That is an anomaly within typical market cycles, within the commodity markets. Again, it's down to this DEI. It's all this fairyland stuff that the world's going to end if you shower too often, and we should ride our bicycles and wear hemp clothing and eat some bugs or whatever.
We'll see how long that works.
So these are,
right. Well, it seems like to me it's like energy, and all energy, whether that's oil, whether that's uranium, whether that's, and the uranium's had a good run here recently, but or whether that's even coal. It seems like it could go up really, really quick. It just needs something to push it. It just needs one thing, because the inventories, and you made the analogy of your pantry's empty and it hasn't been replenished. And so, I mean, I'm just sitting and waiting. Yeah, I guess I'm just having a stream of consciousness now, and I'm just really, so I guess we'll see. Is there any industry, any energy sectors that you prefer over the others?
There are. However, over the course of my professional career, I've learned to not get too excited about one sector often.
Yeah, I can see that.
Because you can believe something only to find something else comes along that you didn't quite quantify that changes that.
Yeah.
There are the known factors that you can look at in terms of supply and demand and all these sorts of things. Uranium was a good one. We got long uranium. Gosh, it's been one of our worst trades. And I say worst trade in terms of longevity. We often highlight it just to point out the fact that you need to have patience. In fact, I got an email the other day where some subscriber said, why do you point out all the things that you've done where you think it's like you've done it wrong? And so that's the very point, is to highlight them. So with uranium, we got long in November 16, and then we pretty much doubled our position by 18.
You were waiting a while.
We had to wait a long time, around nearly 4 years. And then within 14 months, we were up, I think, 5x.
Yeah. It went really quick.
Exactly. Now, we had some clients, fortunately for them, who came in literally just before, and then they turn around and say, well, you guys are geniuses. You made me all this money within the last 14 months. And we're like, no, we made this over 4 years. But again, even if you aggregate it over a 4-year time frame, it's a phenomenal return just on the sector. Okay. So the it's difficult to know what that catalyst can be to move something.
Yeah.
The other thing with the component with uranium that's, I think, makes it somewhat more volatile as well is that the actual end user of the uranium does not give a flying toss about the price. That's because they're the utilities. So if you look at a utility, their cost of capital with respect to actual uranium is such a small fraction of their overall cost of their operating expenditure that they don't care. Its price is irrelevant. It's a little bit like if you would go back to the pantry or you're cooking. Right? So you're cooking your food and, I don't know, you bought some steaks and you've got some vegetables for dinner and everything else. And you're going to put a bit of seasoning, maybe some salt on your steak, right? And the price of the salt has gone up 5 times. It doesn't affect you. You're not going to, we're not buying salt tonight, love. Like it's salt. It's only a tiny bit that you use. If it used to be 50 cents and now it's $5, you're like, oh, that's expensive for salt. But like, you're going to use that salt shaker and it's going to last you for, I don't know, probably like 4-6 months or something. So in terms of the food that you're making, the cost of the salt is irrelevant. That's what uranium is to the utilities. They don't care. They're price insensitive to it. What they do need to have is they have to have the supply.
Yeah.
At any cost, because without the uranium, there is no energy production.
Yeah.
Okay. So it's a very interesting energy source in that it's an absolute must have, simultaneously that they're completely price insensitive to it.
Yeah.
And I think to some degree, that's also why when we look at it, we go, oh my gosh, this is a no-brainer. What the hell is wrong with everybody? These people are clowns. You have to be long this. You just have to be long. And we don't know how long it's going to take for us to inflect, but it's like, it has to be in your portfolio to some degree. So that's just a matter of waiting and position sizing and figuring that out. Maybe it's 2%, maybe it's 5%, maybe it's 10%, depends on your risk profile.
Right.
Fine, but you got to have it. That was our viewpoint. But when you have those sorts of dynamics, again, you'll often look at things and say, well, that's obvious to me. And then you're waiting. You're like, what is wrong with people? Come on, market. And then all of a sudden, boom. And, what was the catalyst there? Well, it's hard to know because stuff moved. And now subsequent to the moves, you had Kazatomprom came out, I think it was in January this year. And they said, oh, well, our forward guidance for 24 and 25 is kind of a bit off. We don't think we're going to meet that. Yeah. Sorry, folks. And it's off by 20%. Yeah. 20%. And Kaz is one of the largest players in the market. And then you had Cameco come out. Same thing.
Same thing. Yeah. Yeah. I was in shock.
And we weren't because we knew the dynamics behind this. We knew, again, coming back to the cost of capital.
Right.
Here's the other thing. We've got a rising interest rate environment. Bonds topped out in 2016. Sure, we had a little bump in with the as my friend George Gammon calls it, the cerveza sickness hysteria in 2020. And we had so bonds rallied. But if structurally you look through it, they were done. End of 16, that was pretty much the end of the bond bull market. Yeah. Ever since then, globally, we've had interest rates rising. In a rising interest rate environment, when the market now perceives that not to be a short-term anomaly, which is going to go back to the status quo, i.e., rates went up 25 bips, but it's okay. They're going to come back down. They always keep going down. That's fine. No, when the market starts going, oh shit, this is a new trend. Maybe they're 25 bips higher by next quarter or next year or whatever. Yeah. And then you think about the capital expenditure industry of commodities in general. It's typically long cycle assets, right? You go and you put a rig in the water, your payback on that thing can be 20, 30 years. Yeah. You need a couple of things. You need to have certainty of political outcome, roughly, to deploy the capital. And you want to know what your financing costs are going to be. Yep. Okay. So now you start extrapolating a rising interest rate environment in terms of your ongoing cost of capital. And so you might look at it and go, oh, okay, I don't know, $50 oil, Yeah, we could do it today. Oh, rates going higher. We just quickly run our little spreadsheet. Shit, no, 50, no, 50, it's not enough margin there. And we're going to spend it. No, we need 60, 70, 80. So again, it restrains capital investment into that industry.
Yeah.
And that would be true even if we didn't have woke, blue-haired people telling us we can't use this stuff. So, but we do. Again, these are good things. They're good things with respect to being invested into certain sectors.
Yeah.
If we're going to be short on energy, i.e. you've got lights out, you might as well make money from it.
Yeah.
And we're seeing that now rolling out across multiple countries where they're going, oh, we got to have shortage of power and stop using your electricity and blah, 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 blah.
Yeah.
I mean, and again, you get like these exogenous events like Putin blowing up his own pipeline.
Yeah.
Which of course constrained energy supply into Europe and the natural gas market. Largely, that was purely purely designed,
yeah, by them.
By certain individuals, which made Germany in particular reliant on American natural gas,
LNG from the States. Yeah, exactly.
LNG from the States at 4 times the price.
Right.
So and the Muppets who designed this particular event or whatever it was didn't understand that there's not the port facilities to actually take in those volumes that are required to actually have Europe operate in the fashion that it did before. So we looked at that. We're like, okay, running all these numbers. We go, I know what they're going to do. They're going to buy coal because it's the one energy source that can be translated or that can be utilized in their grid other than natural gas.
Yeah.
And they don't have any coal. They got rid of all their coal in over the last 15, 20 years. So long coal was a no-brainer.
Mm-hmm.
But even there, coal assets, when we first started buying them, you might recall if you were with us at the time, we were buying companies for 2-3 times earnings.
Yeah, cheap.
With double-digit dividend yields.
Yeah,
it's nuts.
I mean, looking back, it's a no-brainer.
Exactly.
And it's also
again, you didn't need that. You didn't need the Nord Stream problem for that to be a good trade. We were long that anyway. That was an exogenous event that came in, which simply was icing on the cake. Yeah. So sometimes, often we'll be in sectors and then we see something that transpires. We go, okay, that's great. Now we might double up or whatever. We'll change our weighting allocation as a consequence to see what will transpire. Tankers is another one, blocking of the sewers. We go, cool. They're going to spend another 13 days going around. Day rates are going to climb. Right. No supply in the tanker market. Again, capital expenditure. Who wants to finance these dirty vessels that carry crude around? Naughty. No, Greta's not going to like you. Can't have the money. So you have these, again, supply constrained markets whereby you have an inflationary outcome as a consequence. And that, again, none of this has anything to do with the growing economies. In fact, your economy can be falling and you can still have rising prices of these goods.
Yeah. And it's also, I was talking to I was talking to a guest, this was 6 months ago, and he was also very bullish on coal and optimistic. And he made the point that the second and third world economies are huge purchasers, if you would, consumers of coal.
Of course they are.
Yeah.
It's the easiest energy product, and it's the cheapest.
It's the cheapest.
Yeah.
And that was interesting.
There's a bucket load of it. So there's enough coal to keep the world going for at least like another 100 years. So there's not a supply issue with respect to, but there's a production of supply issue.
Yeah, I got it. Are you looking at, I guess, not to get too much into the weeds, but anything outside of commodities that you think are looking interesting here? I mean, I know you had this huge AI tech boom. That does not interest you, I'm sure. But
it interests me a lot. It interests me because if you look at AI has one component that's very, very unique to it. It is massively energy intensive.
Right.
If
Right.
you want to play AI, you play it via the energy markets.
Yes.
And so they've just recently come out with this realization that, oh gosh, these chips consume enormous amounts of energy and we're short of energy. We don't have this stuff. And the hairy armpit crowd have been shutting down all of our energy supplies, and they won't let it into your backyard anymore. They still want to have their AI, and they still want to have their lattes and their cappuccinos and their cell phones, but they can't not really figured out how they actually come about and land up at the Apple store. The disconnect between your urban class and where things come from is quite extreme. So these are, again, good things with respect to that supply side issue. But you play the energy markets, you're playing AI. That's the way. Because look at NVIDIA. I mean, this is absolutely insane in terms of valuations.
Yeah.
And many other companies within that space, most of which, by the way, are not AI. They are simply actually just there was one of my clients, I'm trying to think of the wording, how he put it to me, because he's one of the top developers in the AI space for a company I won't mention, but it's very well known. And he said most of the stuff is not AI at all. It's just an aggregation. It's just it's data computing, but they throw the AI badge on it, and it gets a higher valuation.
Yeah.
So, anyways, it's the same sort of garbage that we saw in the pot marijuana boom back in the day. It's the same sort of stuff that we saw in the .com era. It's the same story all over again. So I don't know how high some of these AI stocks go, but I'm certainly not going anywhere near them. But again, that doesn't mean AI is itself garbage. It's there. It's going to probably fundamentally change a lot of the way things are done in our lives. But the price that one is paying for companies which are so-called in that space is nuts. It's nuts. It's crazy.
Yeah.
But to your point of other things, you would probably be familiar with our play on Argentina, which we got into. That's now, it's done extremely well. I think there is more juice in that orange to come. It's becoming a bit of a problem for some of our clients. And I say that insofar as where you go in with, say, a 5% weighting, and then it's now 20% in the portfolio because it's done so well. It's now a problem. But we like to make problems like that. And then it's just a matter of how do you rebalance and where do you go and what else do you put it into that has a similar upside. One of the things that we've not done anything about it, but we are looking at is the Chinese market. It's been decimated. It's looking kind of interesting.
Yeah. Yeah, that's the thing about you. You really like to play blood in the streets, which is that's an extreme value investor, and that's where you get your big lens. So interesting.
It's a mitigation of risk. People don't understand. It's actually a mitigation of risk.
It really is.
It is. If you take something that you use that you know is going to be used. Obviously, there's like the Kodak moments that come along, but they're very rare. They're like a 1 in a million. And that sector's down 80, 90%, and most of the players have gone away. And then you start seeing actual incomes rising. I mean, the tanker market is a perfect one. These ships cost tens of millions of dollars. That's not cheap. Again, it's a debt finance market. So they're always carrying debt. But you know what happens in bankruptcies? Debt gets wiped out.
Yeah.
The best time to buy them, it's like real estate. The best time to buy real estate is when you can buy an existing, it's not about construction, it's buying existing buildings for 20, 30, 40% of construction cost, where you know you can't build that damn thing today at the price that it's going for. And then you get the land for free.
Yeah.
That's when you have a much lower level of risk. Now, obviously, there's other things. Maybe there's a war going on or whatever that brought it to that. So you got to, that can make sense as to why that is. But those are the types of setups where if you get that and it doesn't really make sense, then just a small amount of your portfolio going into that is probably being patient over time, going to pay you well. It's certainly a much better idea than running out there and buying GameStop.
Right. Yeah. Well, Chris, I don't want to take up any more of your time. If you could just how can people get in touch with you and if they want to do business with you and your funds as well as the people that you lead, how do they get in touch with you?
Sure. So the publication that we run is on Capitalist Exploits. That's capitalistexploits.at, A for apple, T for tomato. And our asset management business is glenorchycapital.net. You can find us there.
Got it. I will link to all of this in the show notes. Thank you so much for coming on. It's early in your neck of the woods. I can see the sun starting to come up from your window.
Yeah, it's rained all night, and it's actually now stopped, which I'm grateful for. So it's actually 10 o'clock in the morning. So normally it's light by now, but it's just been a rainy day.
All right. Well, thank you so much, Chris.
You're welcome. It's a pleasure to meet with you. All the best.
Absolutely.